Welcome to the Authority Hub podcast. I'm Nolan, joined as always by Claire.
And today we're featuring the expertise of Steve Dainard, mortgage broker in Niagara Falls, Fort Erie, on.
If you've spent 30 years building a business in Niagara Falls, kept your taxable income lean the way your accountant told you to, and now you're sitting on $400,000 in home equity that the bank won't let you touch, what exactly are your options at 58?
That scenario is more common than people realize, and it's exactly the kind of situation Steve Dainard works through regularly with clients across the Niagara Falls and Fort Erie area.
Today we're talking about reverse mortgages, what they actually are, who they're actually for, and why the conversation matters right now in this specific market.
And we're going to get into the self-employed angle specifically, because that's where Steve Dainard's work in Niagara Falls and Fort Erie gets really interesting.
Let's start with the client picture, because I think a lot of people hear reverse mortgage and immediately think of a very specific type of person, elderly, struggling, out of options.
That's the misconception Steve Dainard hears constantly, and it leads people to dismiss a product that might actually be the right fit for them.
So let's set the scene properly. Someone comes to Steve Dainard, they're in their early 60s, they ran a business for decades in the Niagara region, they owned their home outright or close to it.
And they want to access that equity. Maybe it's to cover health expenses, maybe it's to reduce financial pressure in retirement, maybe it's just to stop worrying about cash flow every month.
They go to their bank first. That's the natural move, and the bank looks at their income documentation and the numbers don't work.
This is where the system fails this specific type of borrower, and it's worth being precise about why.
Walk us through that, Claire.
So for a self-employed borrower, conventional lenders typically require 2 years of T1 generals and notices of assessment. They average the net income lines after all the business deductions come out.
And for someone who's been running an incorporated business and doing legitimate tax planning, that average NOA income can look very thin on paper.
Exactly, it's not a sign of financial weakness, it's the outcome of doing things right from a tax perspective for 30 years. But the lender's qualifying calculation doesn't see it that way.
So the debt-to-income ratio fails. The HELOC door closes. The conventional refinance doesn't work either because you'd be taking on a monthly payment that doesn't fit a fixed retirement income.
And this is the gap Steve Dainard is describing, the gap between what someone has genuinely built in their home and what the standard lending system will actually let them access.
So where does the reverse mortgage come in?
It sidesteps the income question entirely. There is no income qualification for a reverse mortgage. The loan is secured against the home's value, not your income or credit score.
That's a fundamental shift in how the product works compared to everything else on the table.
Steve Dainard makes this point clearly. For self-employed borrowers who've reached 55, this is often the first product they've encountered where their income structure simply doesn't become an obstacle.
Let's back up and make sure everyone understands what a reverse mortgage actually is, because there's a lot of noise around this product.
At its core, it's a loan secured against your home that you don't have to repay until you sell, move out, or pass away. No monthly payments required.
Canadian homeowners who are 55 or older and own their home, or have significant equity, can borrow against a portion of the home's appraised value. The interest accumulates and gets added to the loan balance over time.
The product most Canadians will encounter is the CHIP reverse mortgage through Home Equity Bank. This is a federally regulated product, not a fringe instrument, not a predatory scheme.
And one of the things Steve Dainard addresses directly is the misconception that the bank takes your home. It doesn't.
You retain full title. The lender holds a mortgage against the property, the same way any mortgage works, and that mortgage gets repaid when the home is eventually sold.
That's a point worth sitting with, because the fear around that misconception is real and it pushes people away from a conversation they should be having.
The other thing Steve Dainard is clear about is that this isn't a last resort. For a lot of retirees and self-employed borrowers in Niagara Falls and Fort Erie, the home is the single largest asset they've built over decades. Using it strategically is a legitimate financial decision.
Let's talk about who qualifies and how the numbers actually work, because the qualification criteria here are genuinely different from anything else in the mortgage space.
All registered owners on title must be 55 or older, the property must be your primary residence, and beyond that, no income test, no debt-to-income calculation, no minimum credit score.
The maximum borrowing amount is based on the home's appraised value. Home Equity Bank allows borrowers to access up to roughly 55% of the home's value depending on age and property type, though most borrowers receive considerably less than that ceiling.
Older borrowers qualify for a higher percentage because the lender's actuarial risk is different. The math reflects how long the loan is likely to compound before repayment.
Property type matters too. Single-family detached homes in established neighborhoods qualify cleanly, and that describes a large portion of the housing stock in Niagara Falls and Fort Erie.
Condominiums can qualify as well, but lenders apply additional criteria around building age and reserve fund health. Rural properties are assessed case by case.
There's also an independent appraisal required, ordered by the lender, cost passed to the borrower, and independent legal advice is mandatory before closing.
That last piece is a built-in consumer protection. The borrower must have their own lawyer, separate from the lender's counsel. Steve Dainard walks clients through each of these steps so nothing comes as a surprise at the closing table.
Now let's talk about the honest part of this conversation, the cost. Because Steve Dainard is direct about this, and it's important.
Reverse mortgage rates run higher than conventional mortgage rates. We're talking roughly 2 to 3 percentage points above conventional 5-year fixed rates, which reflects the lender's risk in advancing funds with no scheduled repayment.
And because there are no monthly payments, the interest compounds and gets added to the outstanding balance. The loan grows over time, and that compounding effect is significant.
Steve Dainard makes multi-year projection modeling a standard part of every reverse mortgage conversation. The question isn't just how much can I borrow, it's what will I owe in 5, 10, or 15 years, and what does that leave for my estate?
That's the right framing. And Home Equity Bank does provide a no negative equity guarantee. You'll never owe more than the fair market value of the home at the time of sale, as long as you've met the mortgage obligations.
That's meaningful protection, particularly in a market where property values aren't guaranteed to keep climbing.
Which brings us to the Niagara market specifically, because local context matters here in ways that aren't obvious from the outside.
Property values in Niagara Falls and Fort Erie are meaningfully lower than in the GTA. That affects the absolute dollar amounts available and how the lender views the collateral.
The market has been relatively flat over the past couple of years, which is consistent with broader Ontario trends. That flatness is part of the honest picture. Someone counting on continued appreciation to offset compounding interest needs to factor that in.
But the other side of that story is that many long-term homeowners in this region bought their properties decades ago. The equity they've accumulated over that time is the foundation a reverse mortgage draws from, and it's often more substantial than they initially realize.
Fort Erie in particular has a demographic profile that skews older, a lot of homeowners who are asset-rich and income-constrained. That's precisely the profile where a reverse mortgage is worth a serious look.
And it overlaps directly with self-employed borrowers who wound down their businesses in their late 50s or early 60s and transitioned into retirement without a traditional pension income stream.
Steve Dainard's experience working across the Niagara Peninsula means that local nuance, which neighborhoods appraise consistently, which property types lenders are comfortable with, is part of every conversation.
Now, a reverse mortgage is one tool, not the only tool. Steve Dainard is explicit about this. The right starting point is always a genuine comparison of alternatives.
So let's run through them. A HELOC is the most common alternative. Lower interest rate, more flexibility. But it requires income verification, and that's where retirees and self-employed borrowers hit the wall we described earlier.
A conventional refinance pulls equity out through a new mortgage, but you take on a monthly payment obligation. For someone on a fixed income, adding that payment isn't always viable even if the math technically works.
Private mortgages are another path, but the rate environment matters. Private lending rates for non-traditional deals in Ontario right now can run 8 to 12%, which puts the reverse mortgage in a more competitive position than most borrowers expect.
And downsizing is the alternative that doesn't get discussed enough. Selling a larger home, moving to something smaller, freeing up the equity entirely, that's a legitimate strategy that some clients ultimately choose.
Steve Dainard puts all of this on the table. The goal is to get the strategy right, not to push a product.
There's also a tax dimension that comes up frequently in self-employed mortgage conversations. Registered account withdrawals trigger income tax. Equity drawn from a home does not.
So for incorporated business owners who've spent years managing their personal tax rate through a combination of salary and dividends, keeping that structure intact in retirement is a meaningful planning consideration.
And reverse mortgage proceeds don't disturb it. That's a point that lands differently when you've spent 3 decades optimizing your tax position.
Let's talk about what the outcome actually looks like for a client who goes through this process with Steve Dainard.
The income documentation barrier that blocked every conventional option stops being a barrier. The client accesses the equity they've spent decades building, without taking on a monthly payment they can't sustain.
The family stays in the home. The financial pressure eases. The retirement income picture becomes workable in a way it wasn't before.
And they've done it with a full understanding of the cost, because Steve Dainard ran the projections, walked through the alternatives, and made sure the decision was genuinely informed.
That's the work, not just getting the approval, but making sure the approval is actually the right answer.
If you want to explore how this applies to your specific situation, Steve Dainard's website at themortgageguyniagara.com covers the full range of products and scenarios he works through with clients across Niagara Falls, Fort Erie, and the broader Niagara Peninsula.
The broader lesson here is that the standard lending system is built around a standard borrower, and a lot of the most financially capable people in this region don't fit that mold. The equity is real. The path to it just requires knowing where to look.
That's what Steve Dainard does for clients in this market, and it's why this conversation matters.
Steve Dainard is a mortgage broker in Niagara Falls, Fort Erie, specializing in reverse mortgages.